Well, greetings everybody, and welcome to the October, call it the Halloween edition of our roundtable. My name is Mark Robertson, and I'm joined here by my friends Ken Kavula and Cy Lynch. Hugh McManus is still engaged in business transactions and travel and will be unable to join us here tonight, but he does send his best regards. I will see him in a few days out in Seattle at the Puget Sound investment weekend here this coming weekend. The program for tonight will include a little bit of fun with dragons, trick or treat. That's actually not an angry mob on your title screen on the banner there. That's a representation of our audience, which happens to be hitting it out of the park when it comes to results, and we'll be talking about that in a few minutes. But again, especially if you're new to this, welcome. If you're coming back, good to see you again. And let's go ahead and get underway. First, to make the lawyers happy, you guys all know this, no investment recommendation is intended or implied by anything that we do here. This is all about education, and we actually think fairly powerful demonstration. It's about for illustration only, demonstrating some very time-honored analysis techniques and methods. But again, it's for demonstration, no recommendation intended whatsoever. Here's our agenda for tonight. You can see our friendly knight there on the lower left. Again, welcome, especially if you're a newcomer to this. We'll go through and talk a little bit about what we do, give you a little bit of background. We do take this pretty seriously. We do like to generate affirmative results. And then we'll launch into discussions of potential challenges within the portfolio. Don't know whether we'll see one or not, but then we'll get into our individual stock selections. You see Cy Lynch has zoomed in on Landauer. I'm going to do Masimo, which is also a repeat selection. Ken will share some thoughts on one of his favorite sources for study ideas for small company investing with the Forbes list, which happens to come out around Halloween. It came out last Saturday, around the Halloween season every year. Ken's going to go into a discussion of his selection, Vera Bradley, and then we'll do a little bit of voting and perhaps a little bit of discussion if we have any time left over. Okay, just to kind of remind what we've been doing this now for about 2.5 years. We meet monthly in this format. We every once in a while we'll have a guest damsel or a guest knight, but we get together and pick 3 or 4 stocks every month. We do get a little bit entertaining with some non-core selections, although I'd have to be the first to admit that some of those haven't worked out quite as well as we would hope, and hopefully they're still a work in progress. Our goal is to maintain a portfolio that basically achieves a long-term relative return. Again, that's relative to the Wilshire 5000 of positive 5 percentage points, or plus 5%. Our accuracy goal, in other words, how many of the selections do we want to see outperform in the stock market since the time we select them, is on the order of 60 to 70%. So we'd love to be in that range for what we achieve. And we think over the long term, the relative return target is achievable, as is the accuracy goal. Here's a little track record as to where we've been and where we hope to go. You can see on the x-axis we've got years of operation, again coming up on that 2.5-year time frame that you see here. We're actually at 2.25 right now that we've been doing this. Let's get the accuracy out of the way first. We actually now are up from, we had been kind of toiling and roiling away in the 30s, and now we have 51, almost 52% of the selections we've made since July a couple years ago have managed to outperform the market since the time we brought them to the table. So 52% is definitely a whole lot better than 30-something, so we'll take that and hopefully continue improving. The dotted line that you see here is right at 5%. We would like to outperform the market by 5% over the long term, and you can see we're not quite there yet. And I just kind of put the dragon there just as a reminder that it's kind of a throwback or a nod to David Gardner of the Motley Fools. He does an entire presentation on the subject of Thar be dragons and how in the old world, medieval times and before that, on the maps for ocean-going folks that had a little adventure in their souls, they used to put dragons on the edge of the map just to remind that every once in a while it could get a little dicey out there at the map's edge. And in this case, you can see the damsels holding off the dragon. Our damsels have actually done pretty well. We have Ann Manning and Kim Butcher have pinch hitted for our knights on a couple of occasions, and they've made several good selections. And that brings us to the far right, where you can see that our relative return is actually approaching zero, down at close to -1% right now. And that's the group effort, but you can see the little shaded open boxes, and let's point out some of these, because this one up here happens to be the guest nights now. And the guest nights so far have been Herb Lemkool, who you may have heard a few minutes ago in the green room, and Nick Strategos of Pittsburgh. This little dot happens to belong to the audience, that the mob that you saw. The audience has made several selections over the last year or so, and we'll try to add to that tonight. So between the guest nights and the audience, doing pretty well. The top bubble here belongs to Mr. Kabula. The next one down belongs to the guest damsels, and then the rest of us kind of fill in, and we don't want to talk about this one down here. Other than that one down there is leaving room for improvement. So again, it all adds up to about -1%, an outperformance accuracy of about 52%. Again, seeming to be in the right trend on the far right-hand side. So onward and upward.
You had to search hard to find a knight with a profile like that guy in the upper right-hand corner there, huh, Mike? Mark?
Actually, he popped up right away, Ken, and
oh, all right.
It's kind of fitting for many of us. Oh, not good. Anyhow, here's some of the more recent selections made over the last several months by the club. This is how we keep track of them on a spreadsheet. We log them in, whether the pick is made by one of the knights, guest damsels, guest knights, or the audience, and then we basically compare the performance of any selection made versus the market since that same time. For example, at the very top you see Southwest Airlines selected on April 30th of this year. It's shown out here in the start date. All of these are still open positions, so there are no end dates in the second column, ticker symbol LOVE. The fact that this particular selection has outperformed the market means that it has an accuracy rating of 1. You only get a 1 or a 0. So 827 at the night that it was chosen is now up to 874. That's a gain of 5.7% during a period of time when the stock market has gone up 0.6%. So again, 5.7 minus 0.6, we get a relative return of 5.1. And the objective is for as many numbers to be green as possible, positive, not negative, in this last column. And you can see that the last several months have been actually quite good to us. Just a couple of exceptions. This one, which is, I'll take credit for, we're waiting for an explosion of interest in research in motion to bring that one out of the gutter. But everything else is actually in pretty good shape. Staples is a many-time selection by Hugh, and he really has a good long-term outlook on the company. You can see Staples on here for a 4th time. In fact, if he was here tonight, he may be picking it. But again, over the long term, the accuracy is improving, and you see the specific results. And what have we done for you lately? It's actually been pretty good. Any questions or comments on any of that, gentlemen? Other than talking about RIM? I am still here, right?
Yes, you are. We just didn't want to take any more rim shots.
Oh, geez. One of the things that you guys and the audience need to watch out for is, for some reason, my internet service has been doing this drift thing where I drift out for 10 to 15 seconds. So sometimes I might be just sitting here talking to myself.
Yeah, Mark, the question board is clear right now, so we're
press on.
We're ready to press on, right?
Okay. Here's a look at the dashboard itself, and again, nothing fancy here. We just simply are listing from the highest percent of total, in other words, highest percent of total assets. One of the stocks that's been selected the most by virtually everybody, every one of us, has been Walgreens. So it represents 6.8% of total assets on the dashboard, and you can see that that actually decreases from there. Now, some of these are single-time selections, some of them are multiple selections. On the dashboard itself, you can actually see when something has been a multiple selection made by all of us. For instance, Staples is a many-time selection, probably at least 5 times. Every time we select a company at the round table, we invest $1,000 into it on that night and basically keep track of it from there. So We'll just leave it at that. So some pretty decent companies, some pretty good household names. I know portfolio recovery could come up in discussions tonight. That has been selected twice by Ken and by Ann Manning. So $2,000 invested into portfolio recovery is now worth almost $3,000 in fairly short order. So that could come up. Here's a quick look at the condition of the portfolio. So we don't really have to do any tremendous engineering of the portfolio itself. With the median stock that we follow with a projected annual return of 9%, we really want the portfolio to be somewhere in that 14 to 19 range. And you can see that the portfolio does check in at 15. So the return forecast, the weighted average return forecast for the portfolio is 15. It's within this target range that you see here. So we get a check mark on return forecast, quality, check, everything's fine with that. Again, that's a figure we like to see somewhere in that 75, give or take, plus or minus range. And then when it comes to growth, again, we want to have enough small companies in the portfolio. 10.6 is also okay. We wouldn't mind seeing a little bit more growth added to the portfolio to push that just gently towards that 11.5% range. But again, all three of the major characteristics check out: decent PE ratio, strong financial strength, and straight lines on the guides. In pretty good shape in general. So again, from a overall portfolio-centered perspective, there is no need to take any selling action or any switching within the portfolio. Having said that, we do like to take and sort the dashboard by projected annual return, and then pay attention to any companies that have return forecasts less than, in this case, MyPar at 9%.
Mark, I'm going to interrupt you. Kay Light has her hand in the air. Kay, you're unmuted. Go ahead and ask your question.
I just need some more volume.
Kay, you're the one that's in charge of the volume, because the volume for us at this end is pretty good. So you'll need to go into your own volume and raise it a little bit if you're having trouble hearing.
Yeah, I have done that. I can hear you well, Ken, but not Mark.
Okay, maybe Mark can boost his volume just a little bit as he's speaking then.
Let me double check mine to see that it's okay. I can boost it just a tiny bit, so I'll try that, Kate. Does that help a little bit on your end? Do a little sound check here in the middle. That should be a little bit louder, hopefully not too loud for everybody. According to the diagnostics, it's checking out okay, so we'll try it from there. All right, so again, we're taking a look at the dashboard. We're actually looking at the bottom segment of the dashboard when sorted by the return forecast descending. And you can see that a couple of the positions have languished a little bit and are down fairly low on the return scale. I would certainly consider these down in this range to be kind of on the lower end of projected return. And there's many different ways to get there, but our favorite way to get there is demonstrated by TJX companies. $1,000 invested into TJX probably almost 2 years ago is now worth almost $2,000. That's why you see the lower projected return here. So the fundamentals are suggesting, and again, that's still fairly close to the market average of 8 or 9%. So there's nothing on this page that jumps off and says, I need to be sold immediately. The only one that jumps off in terms of how our community tends to think about non-core stocks. And again, we like to be a little bit more aggressive with selling a non-core stock than a core holding. And in this case, a company which would probably be considered by many people within the community to be a non-core stock is Portfolio Recovery, by virtue of the fact of this little asterisk. It's not in the Value Line Standard Edition, so Portfolio Recovery could be considered a non-core stock and perhaps a candidate for a challenge by this group. I'm not inclined to go after it. I don't know. Do you guys think we need to get assertive with any selling considerations tonight or not? How do you look at the situation?
I have for a couple of months been looking a bit at CSG Systems. Now, as it turns out, and my principal reason for that, and I will first of all confess that I have picked it. As you can see, there's a little bit of a positive return thanks to the last few months. I believe relative return is still a bit behind the market, if I recall right. But what jumps out at me about CGS or CSG is, first of all, obviously, the 5.1% par that you mentioned, well under my par of 9, but couple that with the quality of only 50, so it's only average quality, and specifically in the aging part of a bull market, I like to look hard at financial strength, and again, it's sitting there right at middle of financial strength. When for purchases, that I'll discuss some with my pick tonight, I'm really looking at about 80, and certainly for holds, 70 or so would be fine, but it's causing me some concern. Another thing that we don't have a slide on and doesn't really impact recent history with CSG Systems, but another red flag that I look at is when I see both quality, when I'm looking at the Chronicle, which for those of you who may need refreshing your memory on what a Chronicle is it, and Mark's going to call one up, it shows the historical relationship between price, par, and quality rating. And if we can get, there we go. If you notice, about the time I picked it the first time, back in April or so of 2011, notice you see the red line and the blue line both going down. That's both quality and par going down. That, to me, is a pretty large red flag. You have, because what that's showing is that your return is going down, not because the price is going up, like TJX, that Mark mentioned, but because the fundamentals are deteriorating. And notice you had that happening, as Mark is showing, over about a 4 or 5 month period of time. Now you can see that since about this time last year, the quality, therefore the fundamentals, have pretty much leveled out, and you have seen some upward price movement that has pushed the par down over that time. So you know, in a way, I'm kind of looking at this may be an opportune time to go ahead and take some money out of CSG, because it's a lower quality pick right now. Again, might perhaps be called a non-core holding. Manifest is only projecting a 3% growth rate, so there's not a whole lot of attractiveness there. So I would challenge CSG for those reasons.
Any thoughts on that,
Mark?
Ken? Yeah, go ahead.
Well, first of all, I agree with Cy entirely on his on the analysis. I don't see a reason to keep CSG in the portfolio. We also have two questions. One of them is a question on vocabulary that maybe we can clear up pretty quickly. Lorraine wants to know, what does PAR and MyPAR, what do the acronyms stand for, and what do they mean?
Okay, I can tackle that one. They're both return forecasts. PAR stands for projected annual return. Those of you out there that are familiar with the stock selection guide, you're basically talking about the projected annual return in Section 5. Again, all of us here basically think of the results in Section 5 as the bottom line result of a stock selection guide. So what you're talking about there is the projected annual return. Now, the MyPAR basically refers to, you know, what if you took and did the analysis on all 2,500 companies that we follow and came up with the average or the median. We actually have used the median. The middle or median projected annual return for all of the stocks in the universe of 2,500 companies that we follow right now is 9%. So in other words, the middle stock, think of it as the average stock out there right now, is at 9%. That's the number that you see referred to right here. So this 9%. So again, what we're talking about in the case of size, CSG Systems is a company that is not an extremely high quality company, not high growth, and coming in at a little bit less than 9%. So it makes it a potential selling candidate. And notice that, as he said, we've actually had quite a good run-up on that company in recent months. Now, one thing that we want to, before we launch into our discussion, that we probably should clear up, anytime that we sell a company, because this is a tracking portfolio, not necessarily a model portfolio. I know that sounds like semantics, but what we do is, let's say we sold Southwest Airlines tonight. We would literally lock this position in at its present condition. So it's called a tracking portfolio, not a model portfolio. And we literally keep track of it on a position-by-position basis. And all we're doing when we sell or remove a company from the tracking portfolio is lock in the results as of that point in time. Now, obviously, we could come back 2 months from now and reinitiate a new position in that company. But again, that's all we're doing when we do that. So with that, I would be in favor. I mean, we can basically, between the three of us, decide this. I would be in favor of selling or removing CSGS from the portfolio.
Okay. And then, Mark, we're also getting some pushback from Ann and from Jeff, and they'd like to know, or they'd like to have a little bit more justification of why, with the low quality rating and the low par value, why RIM gets a pass. Why shouldn't RIM be tossed out of this portfolio?
Okay, that's a very fair question, and I'm certainly the one under the thumbnail on this one. I think, when it comes to research in motion, we're basically talking about a train wreck that's already happened. If you take a look at, I can't pull up a value line on the company because I think value line's probably out of commission thanks to Sandy tonight. But if you take a look at an analysis for research in motion, what you'll find is that many of the analysts who follow the company have forecasts that are in the low double digits, high single digits range, so the damage has basically been done. But if you take a closer look at the value line, actually drag it out and take a look at it, the book value of the company still does check in between $20 and $30. So, is there some value there that's that could be recovered in some type of a takeout? This literally is a situation now where $2,000 invested in it is now worth $700, and unless we were doing tax-related selling, which we would never do in this portfolio demonstration, it's really just a matter of hoping for some type of a takeout or some type of a hope that perhaps no more damage can be done to it. I mean, how low can it go?
0. And we're headed there fast.
I don't know how much debt they have. I don't think they have a lot of debt. That's definitely something that comes to play. Something we should perhaps talk about in greater detail next month and actually show some of this.
Mark, if you want to switch to my screen, I have a RIM value line up for you right now.
Okay. Okay, you might want to bump that up so we can see it. If you can zoom on it a little bit, Ken.
Yeah, I'm trying to clear off things that only I am seeing on my screen here to make it happen. How about going to 150? There we go. And where would you like to move this, Mark?
Well, there's a couple things. First of all, value line is being quite, they're a lot like many rhinos that once they get burned, they kind of overdo it. So their return forecast in the 2015 to 2017 projections is actually for 0 return. $7 going to $7. So I would basically say they're probably overreacting a little bit. Another thing that I just mentioned, if you go down to the capital structure, and this goes to the probability of the company actually going to 0. They have no debt. So, it depends on whether or not they really have any assets that somebody else might be interested in. That could actually happen. It does happen. But they don't have any debt to actually take them into bankruptcy the easy way anyhow. So that takes away some of the risk. If this company had a huge pile of debt and was in the condition that we're looking at in the dashboard, it would have been gone a long time ago. That's one of the reasons that I've still tolerated it, and my colleagues have tolerated it. Now, Ken, if we could go take a look at the book value and the current day book value, and obviously it's going to go down as they have operating losses, but you can see there that the book value is in, it's that actually sixth number down, it still is in that $20 neighborhood. So in theory, the company has some value going forward. So that's why we have it there as a speculation and a hope for some type of recovery or takeout. When I say takeout, I mean acquisition by somebody just to get some value out of it. Okay, so I think we're in agreement on going ahead and dumping or locking in the CSGS systems, and we can actually talk about this one in greater detail again next month, and perhaps take a closer look at portfolio recovery. I would have thrown portfolio recovery on the consideration for closing out the position tonight, but they actually had a whale of a good earnings report tonight at the close of business, so it's probably worth looking and seeing if that has a positive influence or impact on the fundamentals of the company, and it's something we can come back and revisit perhaps next month. That one has done extremely well for us.
Okay, Mark, you're still getting a lot of pushback on RIM, and perhaps we need to put that on the agenda for next month and have a really in-depth discussion about where we want to go. You're getting a lot of pushback from an awful lot of people in the audience right now.
Excellent.
We also have a question. Kay would like to know, where do you get the market return numbers from in the first place that make up MyPar?
Well, we basically, we calculate the projected return for every company based on, tonight's closing price. So we basically take the entire set of companies, think of it as one giant dashboard, and come up with the average or median return forecast for all the companies that we follow. I mean, if you want to play with this concept, you could literally take a value line, pull out 5 companies, look at that, and add up the average of 5 low total return forecasts, and just kind of show what that exercise would look like on a daily basis. You might take a look at our weekly messages that are posted in the forum every Monday morning, and just kind of tinker with that a little bit.
Just in case, I see a question on market return by Valerie, and I took it when I saw it to refer to the market return that we're using to measure our performance against. And if that's the meaning of it as opposed to the projected market return, which is MyPar that Mark has been talking about,
okay.
You get the market return, the historical market return, we use basically a proxy for the Wilshire 5000, which is the VT. You use VTR or VTSMX, Mark?
Use both, but in this case probably VTSMX.
Okay, which is the Vanguard Total Stock Market Index Fund. VTI is the Vanguard Total Stock Market ETF. They're essentially the same. You can use either one.
Right, and we look at the starting and ending values for those when we calculate those percentages.
Well, Mark, I'm going to try to keep us a little bit on schedule here, so maybe it's time to move to the 3 stocks we're going to present this evening.
Well, we're not hopelessly off schedule yet.
Not yet, but...
Okay. All right, Cy, do you want to go ahead and take us into your selection for tonight, Landauer?
Right. Certainly, we'll do that, and I'm sure that Ken was trying to move us along because he figures that I'm going to talk for 45 minutes. But I'll do my best. I'll do my best not to do that.
And your best filibuster, right? Go ahead.
That's right. There you go. My pick tonight is Landauer. It's a second-time pick for the portfolio. I believe Mark did it back in March or April of this year when Manifest also featured it as the Solomon Select pick of that month. And also it makes the Forbes small company list and the screen this year as well, so that Ken will be talking a little bit about later on. And let's go ahead and show the next slide, and I'll show you how I came up with it tonight. I decided that I would accumulate the best overall pick in the current portfolio, so I just took a look at the dashboard for the round table, ranked it by par. Apple, I just haven't been convinced that potential return for Apple is real, so that's why I put a question mark there and moved on. QSII, Quality Systems, and the Hospitalist Company, IPCM. Again, I alluded to earlier in my challenge of CSGS Systems. I'm looking for financial strength of 80 or above right now in the current market, kind of tightening my quality standards because of the aging bull. Both are decent quality companies. Quality Systems, I think, is a 70 on financial strength, which is fine. IPC a little bit lower than that, but they didn't meet my 80%, which left Landauer. You also see Home Away, which is fairly close to Landauer on a return standpoint, but again didn't meet my quality standpoint or quality picks. You might say Emphasis is a close virtual tie on return as well. Quality is great on Emphasis, but I've been picking Cognizant Technology, a peer and competitor of Emphasis, a number of times, so I wanted to stay away from that industry this month. So that left me with Landauer. So that's how I got the actual pick, the screening process that I went through. Next slide. I wanted to just go ahead and confirm that there weren't any potential better candidates out there using Landauer's parameters, the portfolio design characteristics, that being potential return and quality characteristics. I first of all did a stock search using a par of 21%, which was just a little below Landauer's 22, quality of 85, which is just below Landauer's 85, and then again my financial strength of 80. That gave me 5 companies. Again, Decker Outdoor and Baidu. I figured those are way over the 10% above my par. That gets us into the yellow, seeing that they're running, what, 24 and 30% above my par, probably a little too good to be true, perhaps a lot too good to be true. So I excluded them. That again left Landauer. Emphasis is in there as well. I mentioned that, and then the last company on that list is just a little bit lower, and since it's a non-core type holding with the asterisk, like Mark mentioned, I decided that it also did not appear better. And I haven't mentioned it yet, but a major plus factor in my pick of Landauer is that projected yield of 4.8%. So all of that said, I can't find a better stock in Solomon than Landauer, so let's make sure that I'm not missing something in the industry. So let's look at the next slide. And again, this is the environmental industry ranked by quality. You see Stericycle has a slightly better quality rating, but just half the potential return. So the best value based on quality and potential return in the industry right now, I felt, is Landauer. So that's how I came up with it. Let's talk a little bit about the company. Here's just a summary from an investment presentation the company gave back in May. I believe there's actually a thread on the Manifest Forum for Landauer, and I believe Mark posted a link to this presentation. That's the main slides I used. I did update a couple of the slides based on their third quarter report presentation, but this tells you a little bit about the company. It's been around since 1954, operates worldwide with quite a few customers and individuals. They basically, for most of their history, have been in the occupational radiation monitoring business. They have been the provider of services and equipment to employers to monitor radiation levels of their employees to maintain a safe working environment. And that's historically what they've done. That's the principal part of their business today. However, starting in about 2006, they realized that that was a relatively slow growth potential market going forward, and they started restructuring to both do better in their core business, that being the occupational radiation monitoring, help cut costs and become more efficient there, as well as look for some complementary businesses that they could enter and markets. So that's what they've been doing, and I think the next slide may show a little bit about that strategy. As you can see, this first step was optimize the core, which they were looking at costs primarily. Then they moved into seeking to grow that business by entering some new markets and some new customers. And what they principally did there, you can see in that middle column, they have entered into some large contracts with the military for their monitoring of radiation exposure, as well as the first responder market, largely in response to the radiation disaster in Japan. With the that's the sort of first responder market that they're looking at, and as you can see there, they've received $20 million in orders to date there as well. And then their strategic expansion areas, that's where they were going into other areas of radiation monitoring and radiation controls that's complementary. And there's two specific areas they've gone into: medical physics, that we'll look at a little bit on the next slide, and also the medical supply market. And they did those with 2 acquisitions. And here are a little bit more detail about those markets. As you can see there on the left-hand side, the company's anticipates or believes that there's at least $1.5 billion of potential market out there. Remember, this is a company that only has about $150 million, that's million with an M, in annual sales. So there's a tremendous market potential out there if they're correct that it's a $1.5 billion potential market. You see the medical physics, that is using radiation for medical purposes. There's therapy physics and imaging physics. Examples of therapy physics would be radiation treatment for cancer or for other illnesses. Imaging physics is, as it says, is radiation to get images of the body, MRIs, X-rays, and the like. And then the medical products are medical products for use in the radiation treatments or radiation imaging area. So as you can see, they've taken their radiation expertise in the monitoring of occupational and patients, moved in now to using radiation to affirmatively help patients, and then also in addition to the services, there are supplies related to the medical uses of radiation, and they're going into that market as well. And this is just a much busier slide that gives you a little bit more detail of how they've moved from the occupational monitoring prior to 2009, 2010 into the medical physics, and then on down also into the supply areas and where it all breaks out. Next slide. This is just a picture a bit of how they are a global company, and they have sought to expand beyond the United States in their occupational area. That's the principal way that they're seeking to grow that business. And you can see right now about 3/4 of the business is North American, within Europe and the rest of the world constituting 17% and 8% respectively. Next slide. Again, we've pretty much covered this slide in my discussion earlier, but again, it describes the three operating segments that they report, which are the three basic business areas that they are in: the radiation monitoring, the medical physics, and then the medical products lines. Next slide. This is just a little bit of an overview of the core business, the occupational radiation monitoring. You see that a little over 2/3 of their business in fiscal 2011, which is $100 million, were from this area. And again, the biggest way that they are trying to grow this business is by international expansion and by moving into the military and first responder markets. I haven't seen it on any of the slides that I've done tonight. I may have missed it earlier, but I think it may be in the introduction slide. About 90% of their customers come back, renew their contracts, and stay. So they have this is a very steady business that they are in, and certainly helps provide cash flow for their expansion. Next slide. This is just a little more discussion of the military and first responder markets, and they also are working with FEMA as well as the Japanese first responders. Next. This is the medical physics market, and again shows the physics market, about 80% being therapy physics, with about 20% being the imaging physics, and they estimate that market potential to be $1 billion, as you can see, and it's a very fragmented market. There are no major competitors that they're up against. In fact, they are the largest player in that market by about 3 times, and so they feel that they may be looking at growing in that market by acquisition. Also notice the bottom bullet point that they say they have a relationship with 5,000 hospitals as a result of their core business, the occupational monitoring, and so they're going to seek to leverage that by cross-selling their medical physics services to that market. And then the medical products that I've also mentioned, and the IZI medical products, they closed that acquisition last November. And you can see there roughly what they do. They provide consumable products for the MRI, CT scans, mammography technologies. All right, next slide. This just shows you a little bit the results of this diversification by revenues and operating income. The third quarter of 2011, you can see they only had 2 segments at that time: radiation monitoring and measurement, and the medical physics. And then by the third quarter of 2012, they've added the green bar at the top, which is the medical products division, and you can see that the medical products and the medical physics are growing much faster, both as percentage of revenues and percentage of operating profit or operating income, compared with the traditional radiation occupational monitoring. So that's what they're looking to grow those businesses, and where their growth going forward is expected to come from. All right, next slide. This is just my wrap-up of all of that. I'm projecting sales to grow at about 8%, which is roughly the historical rate. If you really believe that they're going to accelerate that growth, which it certainly looks like they could, that may be conservative, but I'm content with that growth rate. The current net margin is just 15%, which you can see by the graph. The right-hand side is below the historical results and is well below the trend line. That is largely because of both acquisition costs as well as some costs in bringing out some of their new product lines and a major revamping of their technology IT systems in their core business that I mentioned how they were trying to optimize the core. These are non-recurring things that have impacted that. They expect that will improve, and I'm saying that it'll come back up about to where the trend line is, maybe a little below, which is 20.5%. And then the PE has been pretty consistent over the last 5-6 years or so, and really over the last 10 that's shown on this graph. And so I'm just running that over at about the 22% that it's been running, which leads to a PAR, or projected annual return, of 18% with a nice 4% dividend included. So this month's pick is Landauer. Thanks for bringing it to us back in March, Mark.
Well, you're welcome. So far that one's turning out a little bit better than some of my others. Pretty good company. Ken, are we doing okay on the questions queue?
We're doing just fine, Mark.
Okay, I'll pick us back up here. All right, I'm going to go ahead and talk about my selection for tonight. My selection will be Masimo. The company is, the ticker symbol is MASI. And again, a little bit of background on how I got to it. You've seen us do a little bit of work in the forum perhaps over the last few weeks where we're tightening down on the sweet spot, talking about perhaps the really sweet spot of not necessarily 5 to 10% better than the median stock, but I don't know, I'm battling a little bit of a case of tennis elbow, and I know what it means to hit a tennis racket on the sweet spot, which is, you know, small and in the middle of the racket. So we're kind of toying with this a little bit. So you can see what I did here is I went out looking for companies that are in the range of, you know, just that 1% spread between 16 and 17%. Now, again, high quality, just like you heard from Cy, decent financial strength, and then this is the Motley Fool's CASPI rating, which we'll talk about in a minute. But this simple screen delivers a much tighter set of screening results, and I've gone ahead and color-coded them by some of the other stuff we'll talk about here in a minute. The ones color-coded in green actually have bullish sentiment right now. The ones in yellow actually have kind of neutral sentiment. So kind of settling in on, again, companies within a fairly narrow range, not getting quite as aggressive as, you know, being up there in that 19 or 20% range. Can you still hear me okay, Ken? I just got a warning.
Mark, you're doing fine.
Okay. Get this out of the way here. Okay, so let's go ahead and switch to the next one. And this gets a little bit busy, but let me just tell you, you know, first of all, coming back here, this is, you know, again, focusing predominantly on those major fundamental characteristics of quality and projected return, you know, when combined with things like the growth rates, the PEs, financial strength, and all that other stuff that we know are very core fundamentals. So we've kind of got that covered. And now what we want to do is basically talk about, well, let's take these 5 companies and subject them not only to fundamental stuff, but how about a little bit of technical stuff? And this is something you've seen us actually share in our newsletter, where we're taking a look at again, all 5 of these are fundamentally very sound. So this is kind of a comparison guide of the 5 companies. Very strong on the projected return, very strong on the quality. Fossil might have a little bit higher quality. But now we're taking a look at some other characteristics. The first being the relative strength, or a flavor of momentum. And again, this is where you hear the talking heads or the pundits talk about companies that are overbought or oversold. And really all we're trying to do in a screening type effort is to find the ones that are more oversold. Anytime a company is below 30, it's potentially oversold. So we've got Masimo, good fundamentals, potentially oversold. All of these companies are actually very well regarded by the stock pickers over at the Motley Fool Caps. And again, you can read articles in the Manifest archives about that. But we just basically rank them to kind of decode that. They're all fine. Again, these 3 in the middle have bullish trends according to the point and figure trend analysis over at stockcharts.com. So again, all we're doing is saying, again, 5 companies with solid fundamentals. This one might be on sale because it's been so dramatically oversold, here in fairly recent history, and expectations or price behavior is actually bullish at this time. You combine that
Mark,
with, go ahead,
Mark,
Ken.
is the momentum rank column a percentile number?
It is simply a percentile ranking. So Masimo ranks in the top percentile of all companies when it comes to momentum right now. Okay?
Thank you.
One of the other outputs, and again, you shouldn't obsess over this or pay too much attention to it, other than I like to think of it as either gravity or price pressure. And downside gravity pulling your price down, or perhaps inflation, or well, inflation is not a good word to use when we're talking about investing, but support or upside pressure. And we do the same thing here. We take a look at where the rhinos think these companies could be going, and then we kind of seek the one that has the most upside pressure. There's nothing wrong with Schlumberger right now. If you buy Schlumberger in your club or individual portfolio, nothing wrong with it fundamentally, but it might be a bit of a laggard for a while, just because of the reduced demand and the diminished expectations. Again, it's from a trend perspective, it's a neutral bear. In this case, though, Masimo has the highest amount of upward price potential, because at a current price of 21 and change, they're basically saying that this could go in a fairly, indeterminate but short amount of time to as high as 36. It has the most upward price pressure. Now we basically just take those three major indicators, put them into one rank, look at our entire universe of stocks. These are all good. These are actually all ranked pretty highly when it comes to momentum, sentiment, or trend, but Masimo does rank in the top 1%. Again, a little bit of verbiage down here at the bottom, types of things that you can search in the manifest forum if you want a little bit more information. But again, what we're basically talking about is a company, fairly well established, one that we've looked at here before, that has strong fundamentals, but also very compelling technical characteristics right now. So what does it look like? There you
Mark,
go.
we're getting some questions. Is the momentum number tied to the RSI number in any way?
Yes, it is.
Does one depend on the other? Can you go into that just a little bit?
Basically what we do is we take a look at the relative strength from top to bottom, and again, those are typically going to range from, well, they could go from 0 to 100, but they're typically going to range from like 20 to 80. Okay, anytime a company is in that greater than 70 range, greater than 70, it's thought of as being potentially overbought. So again, that's what we're looking at here. None of these are in the overbought range. And we basically just take a look at them from top to bottom, more overbought or less overbought, or we just rank them from top to bottom, again, based on these relative strength indexes from, again, over at stockcharts.com.
Mark, I'm going to repeat something here and see if it makes sense. Are we saying with Masimo that only 1% of the companies in the database have a relative strength less than 25.5?
That's correct. And very Socratic. Good stuff. Does that help?
I think it answered a few questions here, yes.
Okay. And I'll take a look at the questions and provide some links after the session. We'll post, of course, we always post this presentation in the Manifest Forum, so I'll scan the questions and see if I can provide some links, including one on just what is this relative strength index thing all about. It's something that we have looked at for a couple of years, but we're still relatively new to many of us. Any other comments or thoughts there, Ken?
No, I think we're doing fine, Mark.
The key takeaway is just to basically think about, we concentrate first and foremost on the fundamentals. As much as 75 to 80% of our total effort ought to be there. And then we're using the technical as a bit of a fine-tuning. And where this really comes home to roost, again, is when we combine those two different types of characteristics into an overall ranking. And again, we're looking for companies that are stacked up well fundamentally and technically. Okay, so here's what the company looks like from our business model analysis. Again, up, straight, and parallel. You see a fairly compelling situation here with the lines definitely aiming in the right direction, with the exception of the price. So you're basically looking at a PE compression over time. That price trend is not it's basically just the type of thing that can be a wonderful opportunity. You see the low total return forecast from Value Line at 20%, so it's looking fairly strong and a potentially depressed stock price there. Here's a look at the profitability over time. Again, we're looking at net margin here. Again, it's been kind of compressing a little bit. We have a couple years of analyst estimates in here, but again, I would basically throw a nickel on top of it and call it 15 at this point. So 15% seems to be a decent place to be. If you wanted to be a little bit more conservative, you might come somewhere in this range with your own analysis, but that's up to you. This company has a lot of strong characteristics. Here's the Value Line snapshot so that we can take a look at that PE ratio compression that I was talking about on the business model slide. You can see it right here. It's gone from the 40s and 50s down into the mid-20s. Again, Value Line thinks that mid-20s is a reasonable place to be. That is in concurrence with Morningstar and Standard & Poor's, so it actually feels pretty good. You can see, again, some fairly steady and pretty good net profit margin numbers. Note that Value Line has a very optimistic 3 to 5 year forecast for the profitability of the company. S&P and Morningstar probably don't feel that strong about it. So much like Cy, I take a look at the company, where it's been, where it's been going. I am compelled or drawn to this relatively steady and quite high quality ratio. So it's got a very high quality rating over the last several months, and we also see that the projected annual return is up, not quite as high as it has been. It was actually up in this range when we selected it the first time for this portfolio. So the price was down, the return forecast was up. So this is the situation that actually worked out for the selection we made a few months ago. And it kind of looks like a thumb. Sorry about that. But the projected annual return now is in the mid-teens to high teens. Definitely meets the perspective of high quality, decent return, fairly reasonable assumptions here on the main core characteristics, and a return characteristic that we like. The real catch to the story is that, again, this is one that Ken actually discovered for us years ago, and these guys kind of specialize in non-invasive stuff in emergency rooms and hospital rooms for keeping track of things. So they're in that disposable razor blade type business of replacing that kind of commodity stuff along with monitoring systems. But again, the key word there is non-invasive and better monitoring characteristics. And it's an area of healthcare that we've been watching for some time, and this is definitely a very promising smaller company in that field. So with that kind of small company introduction, I'll turn it over to Ken, and he can share some remarks on sources of great small company ideas along with his pick for tonight.
Well, thanks, Mark. And Mark, if you could pass the screen to me, I'd appreciate it.
Okay, working on that now.
And I'm going to just pull up my Internet Explorer here. And I'm going to show you that anybody can go to Forbes.com. And I'm walking you through this because it's a little bit buried. And this is just a continuous site. I seem to get that on Forbes.com a lot, not always. But if you get to the basic Forbes site, and it's free, absolutely free, right here in the middle of lists, there's Best Small Companies, and I'm clicking on Best Small Companies, and then right underneath the title here is View Complete List. So what I've come up with is Forbes' newest list. It's only a week or 10 days old now, of the 100 best small companies in America. If you want to know how they've chosen these companies, there's a pretty complete article on the methodology that you can read here. I would love to know how I can print this list off of this website. If anybody finds out, I'd love for you to email me and tell me. but Mark and I, neither one of us can figure out how to actually get this list printed. I know it looks like it should print if you just hit print, and believe me, folks, it doesn't. But you can scroll down this list and you can read the companies, and if you do a little bit of work, you can transfer them to Toolkit, and you probably have enough ideas here to keep you going for the next 6 months at least. The list is headed by Solar Winds, and that's been a company that we've actually picked in the round table here. This sounds like it should be an energy company of some sort, maybe an alternative energy company of some sort, and in fact, it's a software company, so be careful when you decide what the company is by its title. We've also talked about Grand Canyon Education and APEI, American Public Education, a number of times in the last couple of years, so they're familiar names to us. And if you go down this list, you're going to see a number of companies that we've in fact chosen for the roundtable. Here's BioReference Labs, Buffalo Wild Wings, Strayer Education, Lumber Liquidators, Portfolio Recovery. So I think the list is chock full of great ideas. The only proviso is that they're not all great ideas, and obviously you're going to want to study them a little bit, but I just thought you'd like to know that the list is out and a number of us are working on it. What I want to do now is tell you a story, and I'm going to bring up my PowerPoint here, and I'm going to tell you a story about last weekend. My birthday was last Thursday, and we had a big family gathering this weekend, and there were 4 generations of women present at the family gathering. I had spent the morning working with my sister on her portfolios, and she had given me an idea that she wanted to include in her portfolio, and that was Vera Bradley. Now, I don't listen to anecdotal evidence that often, but I think it was important when I heard 4 generations of Kavula women, all of them in love with some type of Vera Bradley product. From the smallest children that thought the wallets were the coolest thing they ever saw, to the aunt, the aunt which is in my mother's generation, who's been carrying a Vera Bradley travel bag for the last 20 years. All of these women found Vera Bradley products that they wanted to buy that were practical and affordable, and that told me that I might have found a stock that I really wanted to investigate. So the first thing I did was I went to the website and I came up with this beautiful picture to start the presentation. This presentation is greatly shortened from what you can find on the website, so I urge you to go to the Vera Bradley website. They not only have presentations like this, but they also have pretty decent PowerPoint presentations attached to every single quarterly earnings call. They have somebody that does a really high-quality job of putting together PowerPoints for the company. Vera Bradley would like to focus on these key investing highlights. First of all, the brand. They'd like to develop the idea that they're a multi-channel distribution model with a very diverse consumer following. They have a huge portfolio of products, and they have a lot of growth opportunities with a proven track record. Let's just very quickly go into a couple of those points. Vera Bradley sells to the public, and they sell handbags and luggage and wallets and cases for curling irons and you name it, and if a woman can use it to store something or to carry something, Vera Bradley makes a product that will help in that whole concept. They sell indirectly. They're in a lot of boutiques. You'll walk into a boutique store. In our neighborhood, for example, we have a very fancy Hallmark card shop that has a Vera Bradley boutique within the Hallmark shop. And on that boutique, there's probably 100 shelf feet of Vera Bradley products, all different colors, all different styles, and you can order anything that they don't carry. Vera Bradley also has their own retail stores completely filled with Vera Bradley products. Mark and I were with our wives in Indianapolis just about 6 months ago or 8 months ago, and we were frittering away some time waiting to go to the theater, and we spent a good hour in a Vera Bradley store at a very upscale mall in Indianapolis, just looking at all the products. And then Vera Bradley also has a huge presence in e-commerce, selling a great deal of its product directly to consumers on the internet. Here's this idea that I just found so appealing. The little girls that were at my birthday party loved Vera Bradley stuff. My sister, obviously my generation, says that when she goes to a Vera Bradley store, it's packed with college students and teenagers, all of them looking for different types of totes and carry-alls. My mother's generation loves the concept of Vera Bradley and has been using Vera Bradley for the last 20 or more years. And so I think it really does cross all ages. It's not one of these fads that only certain ages have an appeal to. Vera Bradley is concentrating real strongly on moving its business in the United States. They're not a large presence worldwide at this point. It's an American brand. It's centered in Fort Wayne, Indiana. And you can see from the maps of the fiscal years 2010, 11, and 12, those are the only 3 public years that the company has, although it's been around for a lot longer than that. You can see their concentration on opening new stores and creating new opportunities to sell their product right here. Long term, I love companies that give me some targets that I can use to measure their performance next year and the year after and the year after. So if when I put a little bit of money into this company, I'm going to be sure to use these targets that Vera Bradley has publicly displayed and then see how well they're doing a year from now, 2 years from now, 3 years from now. I like their targets, mid to high teens for revenue growth, high teens for net income growth. I really, expanding their operating margins by 30 basis points a year. I like these kind of measurable targets, and I will certainly find out if the store can meet these targets as I continue with a small investment in the company. I'm going to go real quickly to the toolkit for Vera Bradley, and remember I warned you that they don't have much history. If you're a traditionalist that requires 5 years or more of history on your stock selection guide, Vera Bradley's not a company for you to invest in. When you turn the stock selection guide over, you'll notice that there's only traded numbers from 2010, 2011, and we're working on fiscal year 2012 right now. My SSG, and admittedly, it's a fairly risky analysis because of the small amount of history, but my analysis gives me about a 20% par, and that comes very, very close to, I've lost the Manifest Investing tab. Isn't that nice? It comes, you're going to have to take my word for it, that it comes very, very, very close to the Manifest Investing number, which I think after this long weekend in the stock market was about 18 point something or other. I'm putting Vera Bradley in this portfolio. It's a much, much more speculative pick than I normally make, but at the same time, it's the kind of small company pick that if I'm right on the long-term trends, that this company can then make me some significant money as I hold it down the road. I don't think this company has been discovered by very many people on Wall Street. I think it's a Midwestern company that's struggling to become national. Once it achieves a national presence, I wouldn't be surprised to see it make an attempt to move into Europe or Asia or any of the other large markets in the world. So I bring it to your attention. I know that a lot of the ladies out there have already heard of Vera Bradley, and I would hazard a guess that almost everybody in the audience that's female has something of Vera Bradley that they own already. Mark, I'll send it back to you if you have any wrap-up comments to make.
All right. Well, first of all, I want to know what you're doing so much with Vera Bradley on your birthday. Nobody bought you any Vera Bradley, did they?
No, I didn't get any Vera Bradley on my birthday. I got some nice things, but no Vera Bradley.
I thought they would have gotten you a curling iron holder.
No, but you know, that's what Natalie and Wendy both picked up one of those when we were in Indianapolis, Si.
Yeah, I still get chills thinking about it.
Yeah, I know. That's the first time that either one of them had ever seen that particular piece of Vera Bradley gear, and they both just had to have one each. And in fact, I think Wendy bought one for a gift for Mark's daughter, didn't she?
Yeah, I believe she did.
I believe she did, right?
Scares me that you recall that. Well, anyhow, just to kind of wrap things up here over the next couple minutes, thanks, Ken. I think we'll probably hear from Vera Bradley again in the future and expand a little bit more on the analysis, but that was one of my top picks for tonight also. So I did want to make the audience aware that we do have a dashboard of the companies that passed a kind of a fairly assertive screening process from that Forbes list. There are two dashboards that manifest investing. I'll show you where to find them here in a second. This one is actually the survivor list. Companies from top to bottom, you'll recognize many of those. And then we also have all 100 companies in a dashboard of its own.
Mark, I do have a poll for our companies this evening if you want to run the poll.
Yeah, let's go ahead and launch it.
Okay.
So we'll ask the audience to go ahead and place a vote for any one of the three companies discussed here tonight. Did you put none of the above on there also, Ken?
I certainly did.
Okay. So let's go ahead and do that. And again, we will stick around for questions for a few minutes. We do like to bring these in at about 75 to 90 minutes, and we're pushing up against martini time, I think.
We're asking you to vote. We have 63% of you already voting. What company would you like to see added to the portfolio? We're up to 80% of you voting. We did go past the 100 mark again in attendance this evening. I was very pleased to see that.
I'm surprised with all the weather and all the natural disasters.
Yeah. 85% of you voting. Let's get 2 or 3 more of you voting so we can hit 90% here. If you haven't voted, just take a plunge and pick a number on the screen with your mouse, okay?
Just make sure that it's Landauer.
Okay, we just went to 91%, so I'm going to close the poll, and I'm going to share the results of the poll. And Si, you have a winner this evening. 46% of the audience would like to see us add a Landauer, 26% Vera Bradley, 23% Masimo, 5% don't like any of them. So we will add a second position in Landauer to the portfolio, and we'll see how well the audience does. We've been keeping track of just the audience's picks, and so far they've done a pretty good job of picking the best from whatever we offer.
Not surprised by the wisdom of communities ever.
Okay,
so we'll
Mark, I've hidden the poll now, so I think we're ready to move on.
Okay, I think with that we'll just go ahead and wrap up for tonight. We can stick around for a couple of minutes for any questions, but again, I want to thank my colleagues Ken and Si for their work here tonight. Hopefully we'll continue to generate positive green relative returns in that far right-hand column, and I like all three of these. In fact, all three of these came up in our IRA discussions this weekend at our family stuff, so very interesting.
I'll tell you, Nancy Buffet is telling us that she was able to capture the whole list with a copy and paste into a Word document. And Nancy, I'd love for you to send it to me, kcavula1@comcast.net. I'd love for you to send it to me since you already have it. Roy was able to print his Forbes list, but he has a Mac, okay?
But he did it as a PDF.
Roy, if you want to send me that PDF, I would love that as well, okay?
Forbes
And
must like Macs probably. They're an Apple bull.
They definitely are
Mark,
Apple.
Butch is asking, do you use the website earnings.com? And if so, has it given you problems in the last day or so?
We have in the past. I do not use that actively now. We have used it in the past from time to time, so I can't answer.
Okay.
For the more recent history. I did want to show where the published dashboards are for those of you that would like to play with your own dashboards when it comes to the Forbes list. If you go into the published dashboards from our homepage, just kind of page down, you can actually see where we've got the Forbes Best Small from 2012. These are the 15 or 16 that survived the list. And if you'd like to look at the entire list, come up here to the top where the 100 is still in the title. I'll click through on that just so you can see it. And again, now you're looking at the listing of companies. Again, $100 invested on October 19th, so some of them have actually gone up fairly well here, but all 100 of them are there for you to take a look at and screen away to your heart's content.
Mark, when you get that PDF, do you think you could put it on your Facebook account for some of the folks that would like to have it?
We'll definitely put up some links to this information. It goes really well with trick-or-treating.
Okay. And Mark, Nancy would like to know, what criteria did you use to narrow that list down, or was it based on the whole dashboard that you're showing us right now? Or that you did show us?
Predominantly, and in fact, in the weekly message last week, and I'll include a link to that in our commentary after the meeting. I pointed out how, if you look back at Ken Kavula's selections over the last several years, using this Forbes list, the ones that have the highest actual returns achieved, actual returns, are typically the ones that have the highest quality ratings, going back over the years. In other words, avoid the ones that are just weaker from a quality standpoint, perhaps a little bit immature, that sort of thing. And so with that in mind, all I did was simply take the list of 100 and tighten down pretty hard on quality, earnings per share stability, financial strength. As you look at this list on the screen right now, you can see that most of them are very high in financial strength and pretty high in quality. And again, if the track record it means anything, again, don't just look at the returns, but look at the quality ratings, because they really do tend to go together. And I mean, and just think back to some of the companies that we have enjoyed over the last several years, including SolarWinds over the last year. The two characteristics are extremely important for all companies, but Ken's pretty much got me convinced that they might even be most significant and important for the smaller companies. So just something to keep in mind as you whittle down that list.
We've taken care of the questions, so we're doing a good job here. I don't see any hands raised at the present time.
All right, well, let's turn everybody loose to their to whatever they need to go do. I'm really glad that the internet stayed up and that our electricity stayed up.